Hello, this is Kirill from forexboat.com and welcome back to the course on money management. In the previous tutorial we looked at Kelly's chart and today we're going to talk about the half Kelly. So here's the chart that we discussed last time, and as you remember we broke it up into four sections. Everything before the half Kelly, between half Kelly and Kelly, Kelly to 2 Kelly, and everything over 2 Kelly. So the question now is, why is half Kelly such an important breaking point? Why is it on this chart? Why is it breaking up that segment into two separate sections? What's so special about the half Kelly? Well, it's got quite a few interesting properties that make it a valuable checkpoint for investors. So to start off with, if you move from Kelly to half Kelly on the risk axis, your risk decreases by 50%, which makes sense because you're basically halving your Kelly and therefore your risk is halving. But let's have a look at what happens to the return. Your first instinct would be that if you decrease your risk by 50%, then your return should also decrease by 50%. But because the profile of the return here is not linear, it's actually a parabola, what you will see is that if you go from your return at the Kelly point to your return at the half Kelly point, your return will only decrease by 25%. And you can check that for yourself. You can see it from the chart. You can see right away that the vertical decrease is less than the horizontal decrease. But also if you just compare the actual calculations, just perform the calculations of your return at 1 Kelly and at half a Kelly for any Forex strategy or any kind of coin tossing game or any investment strategy for that matter, you will see that it's always like that. The return only decreases by 25%. So that's quite a valuable observation for investors because it's a good trade-off in a lot of cases to reduce your return, sacrifice 25% of your return, but in exchange get a reduction in risk of 50%. That, for a lot of investors, that is quite an attractive offer. But it doesn't stop there. Let's have a look at what happens to the volatility if we go from Kelly to half a Kelly. So volatility decreases from here to here. And it doesn't look like a lot on this chart. In fact, it looks so small that you don't even have to think about it. But this is the point where I'd like you to remember what I asked you to think about when we were deriving this volatility chart. And that is that this chart has been compressed vertically. We're talking just about the volatility chart, the red line. It's been compressed vertically and it's been stretched out horizontally. And that is why I asked you to remember where the diagonal for that particular chart lies. And I'll just put it back on the chart here. That is where the diagonal is. And so what this means to us is that if we go back to the original non-altered red line, this is what the situation will look like. In reality, by going from 1 Kelly to half a Kelly, we are decreasing volatility by a very large amount. In fact, it is more than 50%. So the diagonal here represents a linear decrease. So if you go from 1 Kelly to half a Kelly and you're on the diagonal, your volatility in that case would have decreased by 50%. But because we're above the diagonal and the red chart is decreasing faster than the linear gray line, that means that whenever we go from 1 Kelly to half a Kelly, our volatility on the account decreases by more than 50%. And so that means that going back to our Kelly chart, here we can say that in addition to the return decreasing only by 25% and the risk decreasing by 50%, we also now know that the volatility decreases by over 50%. And so together, combined, those three properties make half a Kelly a very important feature in trading and specifically in money management. So let's just sum all of this up. So we've got half a Kelly. Important features. First of all, it provides a 50% reduction in risk compared to a full Kelly. Also, there's more than 50% reduction in volatility. And finally, for all of this, you only have to pay with a 25% reduction in return. So that's what makes the half Kelly a very special point on Kelly's chart, and that's why a lot of investors actually go for half Kelly rather than the Kelly. And that is also why the area between the half Kelly and the Kelly is called the aggressive risk-taking zone. You are getting a bit more return in that area, but at the same time you're risking much more and you're substantially increasing the volatility on your account. And a lot of traders don't see that risk warranted. So the return you're getting may not be worth it. And just to finish off, the half Kelly provides one more bonus feature that is worth mentioning, and it is called increased tolerance for errors. So if in your Kelly calculation you made some errors in the sense that you used an average of your profitable trades and your losses on your account for the past couple of months, that might not be the most accurate way of approaching the problem, and therefore your Kelly might be calculated with a bit of an error. So if you use the half Kelly, you have a bit of a safety net, and that is always good to have just in case your past trading history is not entirely reflective of the trading strategy you're going to be applying this Kelly criterion to. So on that note, we'll finish off today's tutorial. Next time we'll have a look at a real Forex example of how to apply the Kelly criterion in your trading. I look forward to seeing you then, and until next time, happy trading.